Hi, and welcome to Module 3 of the EVP competency modules. This module's referred to as accounting considerations. So it's not the sexiest sounding topic in the world, and traditionally it's one of those areas where I thought probably didn't really deserve its own module within the program, but it's actually a really interesting area, and I've had a few experiences over the last 5 years that have shown me just how important some of the accounting considerations are. And in particular, just simple things such as having really clear identification between direct and indirect costs, how much value it can really improve to the earned value process itself, and how well the project's tracking. So accounting considerations. So I guess the key accounting considerations are the collecting and reporting of project actual costs. There's cost accounting standards and disclosure statements that need to be complied with. There's the process of mapping actual costs to the appropriate final cost objective or a WBS element. And these include direct costs, indirect costs, or indirect or overhead costs, unit or lot costs, and subcontract and material costs. So within the or skills and knowledge of the AAC International Cost Engineering Skills and Knowledge, they've organised the accounting considerations according to the systems shown on the slide here. So it's basically system identification, direct costs, control accounts, indirect costs, unit and lot costs, and material planning and control. So the accounting process must ensure that there's consistent and accurate collection and reporting of the actual costs and accruals associated with each control account. This means ensuring that the cost collection process adheres to the accepted accounting principles. Where possible, it allocates overhead costs in accordance with the organisation's accounting principles, and it ensures that actual costs are collected and compared to performance in the same way that they're actually planned. This is really important. So it's about having that apples and apples comparison between the actual costs that are coming through and the budgets that have been assigned and allocated in the schedule. So firstly, on the as far as the system identification is concerned, the accounting system structure is typically defined by the contractor's cost accounting standards or disclosure statement. So it's about recording direct costs in a manner that's consistent with where the budgets are allocated in a formal, consistent in a formal system controlled by the general books of accounts. And it's about summarising direct costs from the control accounts into the contractor's organisational elements without allocation of a single control account to two or more organisational elements. So what that basically means is that each control account should only be allocated to one control account manager, if you like, or one organisational unit. So no doubling up of scope and reporting. It's really important that all indirect costs, which can be, which will be allocated to the project, identify unit costs, equivalent unit costs, or lot costs when needed. Okay, so for materials, it's really important that the accounting system will provide an accurate cost accumulation and assignment of costs to control accounts in a manner consistent with the budgets by using recognised acceptable costing techniques. So you can see the ongoing theme here is it's about allocation of costs, so allocation of actual costs in a manner that's consistent to the way that they were planned. So once again, this is one of the side benefits of earned value, is it's forcing that collaboration and alignment between cost control teams, or often project accountants in a traditional sense, with the planning and the scheduling team who are allocating these budgets within the schedule. So cost performance measurement at the point in time most suitable for the category of material involved, but no earlier in time than the progress of payments or the actual receipt of material. So the idea is that for material transactions or procurement of materials, it's about having that consistent process between the way you've planned to accrue and accumulate those costs compared to the way that you do it in your cost system. And of course putting the criteria in there that the progress that the performance measurement can't be claimed any prior to the material arriving or the actual progress being claimed, the material payments. Full accountability of all material purchased for the program, including residual inventory. So the whole idea is about being accountable for all of the material that's been procured for the project. The costs are usually organised into the following categories within a project implementing EVM. Ideally, each work package should consist of one of these types. So the typical categories are labour, material, equipment, subcontract, and other direct costs, which usually captures the miscellaneous stuff like travel and some of those sorts of things. Our costs are also organised and categorised as either direct or indirect or overhead. So direct costs, so the traditional definition is that they're identified and related to a specific cost objective within a project. So in earned value management, the relationship we draw from that is that they're related to a specific specific control account. So that if it's related to a specific control account for discrete work or for level of effort work, then it's generally regarded as a direct cost. Whereas overhead costs are costs that are not directly related to the project, but they are attributed to the project in some way. So some of these sort of costs might be the organisational costs, office space rental, HR, IT systems, and some of these sort of costs that tend to just get smeared by the organisation across the projects that are being run. So overhead costs include indirect labour, so not directly associated with the project, such as management support, general and administrative, IT, medical. Sometimes procurement and material receipt might be regarded as an overhead cost. Sometimes it might be regarded as a project direct cost. General plant and facility, general and administrative, HR, taxes, insurance, financing, some of those sorts of areas. The process of establishing, implementing, controlling and evaluating indirect budgets and costs that are occurred and allocated to individual projects is something that's really important to understand. It's often something that's outside of the area of the project controller or the earned value practitioner. But it's important to at least have an understanding of what that method is, so that as budgets are being established and baselines are being set, there's a clear understanding of what contribution those overhead costs have to those budgets. And down the track, the idea is to be able to separate those costs so that it's fairly clear if there's a change in the arrangement for overhead costs, for example, that it's not disrupting the earned value reporting process. As I mentioned, it's normally, those sorts of things are normally managed at organisational levels where costs are not specific. The allocation method should be something that's regarded as a fair share, as a bit of an expression for direct budgets across the affected projects. So it's quite common to see them incorporated into burden rates or additional rates that get baked into labour rates for different types of workers and some of those sorts of things. So the assignment of responsibility for overhead cost pools involves the formal assignment of duties and limits of accountability, description of the indirect cost system, and policies and procedures applicable to the establishment and control of those indirect costs. So the more you can have that clear distinction of exactly which costs are being treated as this overhead pool, and as much as possible as that can be the same method that's used in the estimate, the same method that's used in to allocate the budget, and then for that to actually be the reality of the way that actual costs are being allocated to the project is a really important factor. And if you don't have that, it can really mess up the system a little bit and reduce the amount of value you get from it. It's important to establish realistic time phase budgets for forecasts of overhead costs by organisation or the burden pool. And it's important also to compare the direct business case to determine the allocation rates to be applied to each project. So there would be a proposed allocation that's is incorporated within the original business case or the original estimate. It's important to keep that as a benchmark to track against as well. Variances in overhead costs should be analysed at least monthly, just to keep the tabs on them. The accounting system must control retroactive changes to actual costs. Retroactive adjustments to costs can only be made for routine accounting adjustments or for correction of errors. So generally the whole EVM process should be very forward-looking and proactive, with retrospective changes kept to an absolute minimum, and for specific purposes such as correcting accounting errors or anomalies. So it's important also to ensure that there's accurate summarisation and mapping of costs from the general accounting ledger to the control account or the WBS roll-ups, without the allocation of direct costs to two or more higher-level WBS elements. So once again, this is getting back to that hierarchical nature where all costs should only be associated with one WBS element. We need to also ensure that accurate cross-cuts or slicing and dicing of summary information can be enabled by the work breakdown, by the organisational breakdown structure, so that performance can be rolled back to different organisational managers, and a variety of other different reporting regimes that can be tailored to suit using codes. The estimated actual costs or accruals is a really important aspect, and organisations that are new to earned value tend to struggle with the accrual process. It's probably one of the toughest areas in making that transition to an EVM process. But the whole idea is that if you're just relying on actual costs alone without performing the accruals, then every month you're going to have a bit of a discrepancy for work that's in progress, where your schedule update clearly shows a percent complete and an associated earned value with it. But if you haven't received the invoice yet, or you haven't the finance team haven't processed the invoice yet, that would create a very big discrepancy in the earned value system, because you'd have zero cost, you'd have a lot of progress being made, and we don't want to have discrepancies like that flowing through into the reports. So the process for dealing with that, for that late processing of actual costs, is what we refer to as accruals. And so that's about essentially having a rigorous process, or an effective process for estimating those actual costs of what they are at month end, so that they can be put into the earned value system as an accrual or an estimated actual, without having to wait for all the checks and balances to happen with the official processing of the invoice. So it is an estimate, but it's fairly easy to work with contractors or vendors to have that type of information coming through in sync with the end of month process, so that it squares away any artificial variances with your performance reporting. So accounting for unit and lot costs. So unit costs are the cost given, is the cost of a given unit of a product or service, and it's normally derived from a measurable work item quantity within a set that's assigned a particular price. So it can be labour, material, equipment, subcontracts, or even ODCs with their applicable markups. And the unit cost will be the sum of all of those different factors allocated to a particular unit to come up with a value or a cost for that particular unit. So it's a sum of all of them divided by the quantity of work expected to be done to come up with a cost per unit allocation, essentially. Now, this is to be in contrast to lot costs, which are the costs for a definite quantity of some product manufactured under conditions of production that are considered uniform. So with material planning and control, the material costs should be recorded on an as-applied basis, and EV for material must be taken in accordance with how it was planned, as we were saying before. So estimated actuals or accruals are used where EV has been earned and the actual costs have not yet been entered into the accounting system, most often because the invoice hasn't been received or processed. Okay, so, and this is how we mitigate any false variances from happening. Estimated actual costs or accruals are reversed when the actuals are realised. So it's important to realise you're putting in an estimate, a rough number, but when the actual invoice does come through and is processed, say a week later, that the accrual is actually automatically reversed out, and the true costs of the invoice go into the finance system. So it's continuously correcting itself once the facts come through after the original estimate has been made at the end of month. So to provide detailed and accurate data for variance analysis, the EVMS should provide the following capabilities. So the planning of material costs, or the planned value for work packages and planning packages within a control account, must be consistent with the contract statement of work and a payment schedule. Recognition of earned value and actual costs occur at the time purchased materials are either issued for fabrication from the warehouse for a workshop environment, or by the vendor and supplier, and when fabricated items are issued from the project warehouse for assembly, as a standard method for planning and for claiming earned value and attributing actual costs. So the accumulation of material costs incurred or actual costs using acceptable costing techniques and material accountability. The ability to segregate, identify and analyse the cause of usage and price variances for all material types. So that's about being able to track changes in quantities as well as being able to track changes in price or the costing of the materials. The ability to segregate, identify and analyse the causes and usage of price variances for all types of material. The ability to determine and analyse unit and lot costs. And the estimate of actual costs for accruing should be done as late as possible in the financial period so that the accrual is more accurate. So this is one of the weaknesses of the accrual process, is that you're having to make a guess, or an educated guess. So the whole idea is about getting the timing right so that you're making that estimate as late as possible in the reporting period. So if it's a monthly reporting period, leaving it as late as you absolutely possibly can in that monthly reporting cycle so that you can have more confidence that it's the correct numbers being reported. So production materials, so materials that are directly incorporated into the deliverable end items are referred to as production materials. Now they're planned and purchased in accordance with the contract requirements and are typically placed in a warehouse or some sort of storage area upon receipt and acceptance. For non-production materials, so materials that aren't directly incorporated, materials, tools that indirectly support the end products, such as engineering materials, tooling materials, purchased tooling. The planned value and earned value should be earned at the point of receipt, so as soon as they're received rather than when they're distributed from a warehouse. The actual cost is similarly recorded and reported at the point of receipt, so the idea being that at that point the earned value and the actual costs are both earned and accrued at the same point in time. So another key element to remember, particularly when you're on larger, more complex projects, is that, and it's fairly similar to what we were talking about earlier with different work packages and having increased sensitivity where you have higher risk. With material, it's the same thing. So there's no requirement to track and measure and earn progress on every single material item. So there's a bit of a judgment call, and almost like the Pareto principle. There is that general trend that 80% of the material, or 80% of the cost, is made up by 20% of the actual material items. So by identifying those higher value items and putting extra rigour into tracking and measuring and having a consistent process for those is a good place to invest the energy and the administrative effort. Whereas the low value materials, the low cost materials, there's no need to have such a structured, or there's not as much value or benefit to be gained by having such a rigorous process for accruing and receipting those sort of materials. So by focusing on the higher dollar value, generally, materials, it just helps ensure that you're not going to have you're not going to have too many bumps and lumps in your EVM system. So your big costs are going to be in sync with when they're received, and you're not going to have too much administration either. So the earned value basically equals the budgeted unit price of the item received times the actual quantity received, and the actual cost equals the purchase order unit price of the item received times the actual quantity received. So it's fairly simple arithmetic, just using a unit approach. So for low dollar value materials, 20% of material costs for the project might contain 80% of the material items, so a really long list of material items. Make it as simple as possible. So these can be taken as percentage complete. They can even be blended up and rolled up into apportioned effort and level of effort. Some of them might even be able to be rolled up within, for example, other direct costs as a cost that really doesn't need to be tracked on a micro scale. So material variances. So I mentioned earlier it's important to track both price variance and quantity variance. So price variance is the earned price per unit, less the actual price per unit times the actual quantity issued or received, whereas the usage variance, which is I guess the quantity variance, is the earned quantity less the actual quantity used times the earned price unit. So there's two types of variance that can happen. One is a change in the price. The other one is a quantity in the number of these types of materials that you might require on a project. So in review of the accounting module, so firstly, direct costs are kind of the simplest and the most important ones to have a good command of. It's a very formal cost accumulation system, so it tends to be discrete work packages where progress is measured well and actual costs are measured very cleanly and allocated to those work packages. It's a mapping from the financial system to the WBS as simple as possible, and that can then roll up as well. These costs should also be able to be mapped to the OBS, which should happen naturally because if you have a RAM, a responsibility assignment matrix, there will automatically be that association between the organisation and those control accounts. Recording of overhead costs, so having that clear understanding of what the basis is for the overhead costs and the method that's being used on the project is really, really important. Identification of the unit costs, particularly for repeatable units on the project, and having a sound material account system where you have that consistency in particular with the way that earned value is claimed for material procurement and the way that actual costs are accrued for material equipment. And by having those two aspects in sync, it will help ensure that when variances are popping up in your reports, they're real variance, they're not just noise because of your financial system and your progress system in your schedule being out of sync. So that's the end of the accounting considerations module in the EVP certification program. So I encourage you to go through to your study guide. Thank you.